The U.S. Treasury bond market remains a cornerstone of the global financial system, influencing interest rates, inflation expectations, and investment strategies. As economic conditions shift in 2025, investors must stay informed about key trends affecting Treasury yields, Federal Reserve policies, and market demand. Whether you're a seasoned investor or just entering the bond market, understanding these top 10 trends will help you navigate the evolving landscape. 1. Impact of Federal Reserve rate cuts. The Federal Reserve's decisions on interest rates significantly impact Treasury bonds. With inflation moderating in 2025, the Fed is expected to cut interest rates, making Treasury bonds more attractive to investors seeking safer assets. Lower rates typically push bond prices higher while reducing yields, benefiting long-term bondholders. However, investors should remain cautious about sudden policy shifts. 2. Rising demand for inflation-protected securities. With lingering concerns about inflation, demand for Treasury inflation-protected securities, TIPS, is increasing. TIPS adjust their principal based on inflation rates, providing a hedge against rising prices. As inflation trends fluctuate, more investors are allocating capital to these securities to safeguard their portfolios from eroding purchasing power. 3. Foreign investor participation. Foreign governments and institutions remain major buyers of U.S. Treasury bonds. However, geopolitical tensions and shifts in global trade policies could impact foreign demand in 2025. If countries like China and Japan, two of the largest holders of U.S. debt, adjust their Treasury purchases, bond yields could see unexpected volatility. 4. Growth in short-term Treasury demand. Many investors are favoring short-term Treasury bonds over long-term options due to economic uncertainty. Short-term securities like the 3-month and 2-year Treasuries offer higher yields and lower risk compared to long-term bonds, making them attractive in an environment where interest rate changes remain unpredictable. 5. Increased issuance of Treasury bonds. The U.S. government is expected to increase Treasury issuance to fund budget deficits and new infrastructure projects. Higher supply can lead to rising yields as the market absorbs the additional debt. Investors should monitor bond auctions and government debt levels to anticipate market movements. 6. Shift toward sustainable and ESG bonds. As environmental, social, and governance (ESG) investing gains momentum, Treasury bonds linked to sustainability initiatives are gaining traction. The U.S. government is exploring options for issuing green bonds to finance climate-related projects. These bonds could attract ESG-focused investors while diversifying Treasury offerings. 7. Yield curve inversions and recession fears. An inverted yield curve, where short-term Treasury yields exceed long-term yields, has historically signaled potential economic slowdowns. While recent inversions have not always led to recessions, investors should carefully watch yield spreads between 2-year and 10-year Treasury bonds as a key indicator of market sentiment. 8. Corporate bond market correlation. Treasury bond trends influence corporate bond markets, particularly investment-grade debt. As Treasury yields fluctuate, companies may adjust their corporate debt issuance and refinancing strategies. A decline in Treasury yields often leads to lower borrowing costs for corporations, affecting fixed-income investments. 9. Role of the U.S. dollar in Treasury markets. Treasury bond performance is closely tied to the strength of the U.S. dollar. A stronger dollar makes U.S. bonds more attractive to foreign investors, while a weaker dollar could reduce demand. Currency fluctuations and Federal Reserve policies will continue shaping Treasury bond yields throughout 2025. 10. Liquidity and market volatility. Market liquidity remains a critical factor for Treasury investors. In times of economic uncertainty, investors often flock to highly liquid Treasury securities, driving up demand for 10-year and 30-year bonds. However, sudden shifts in Federal Reserve policy or geopolitical events can trigger volatility, affecting pricing and yields. The U.S. Treasury bond market is poised for significant changes in 2025, driven by Federal Reserve policies, inflation trends, and global economic dynamics. Investors should closely monitor interest rate adjustments, foreign participation, and shifting demand for inflation-protected securities to make informed decisions. By understanding these top trends, Investors can better position themselves for success in an evolving bond market landscape.